Well, it's good to be back with you. I'm Nicholas Bohnsack, President and Head of Portfolio Strategy for Strategas, Baird's investment strategy arm. Many of you have asked us what we make of the recent backup in interest rates, particularly the prevailing yield on 10-year U.S. government bonds, which started the year, as we discussed last week, at 92 basis points. That's less than 1%, but have now broken decidedly above 150 and approaching 160. We know higher bond yields make equity markets nervous, and we can see that in the tape. The current bout of equity market volatility underscores the importance of regular conversation with your Baird financial advisor and the benefits of long-term planning. More directly, we would look at weakness in the bond market, the backup in interest rates, and the resulting volatility in the equity market as both a test and a signal. The test comes in the form of markets staking out the pressure points of a new policy regime, in this case the Biden administration and Democratic majorities, however thin, in both chambers of Congress. And while not a new regime over at the Fed, the tempting opportunity for the markets to compare the stated policy proclivities of Fed Chair Janet Yellen with those of newly minted Treasury Secretary Janet Yellen. It's interesting stuff, and perhaps annoying to watch, but ultimately not enough, in our view, to knock the market or the economy off its rails. And therein comes the signal. Is the proposed $1.9 trillion stimulus too much? Is it necessary given the increasingly successful administration of a medical solution, the vaccine, to our medical problem, the virus? It would seem the market thinks so. Yesterday's auction of 7-year U.S. government bonds was weak, and this creates an issue for the Treasury Department as they'll likely need to scale up debt offerings to pay for incremental stimulus. As we approach the statutory debt ceiling as early as late 2Q, this could prove a sharper political thorn in the administration's side. It may also provide the bargaining power the GOP needs to forestall increases to that other funding mechanism, taxes. Time will tell. We suspect the sharp rise in yields heightens concern that inflation will be more pronounced than first thought, and that higher levels of Treasury debt could compete with mortgage markets and blot an important bright spot in the emerging recovery. The key on all of this will be follow-through. Consider this chart of the current advance in equities off the March 2000 lows with similar moves in 1982 and 2009. The recovery needs to grow into itself. It needs to deliver against expectations. The periods of consolidation that have followed major market bottoms allow all the moving parts to reconnect. It doesn't help that economic data has been choppy recently, or weather-related disruptions have lengthened the soft patch. But we wouldn't be overly concerned by market dislocation in the near term. We believe the building blocks are in place for a durable economic recovery. Remember the sequence. A recovery catalyst, in this case the reopening, leads to increases in activity, demand, output, revenue, investment, and profits. We're not at the reopening yet. So hang in there. For as quickly as the last year has passed, it feels like forever. Stick with the Baird team, and we'll get there. Together. Stay well. We'll see you again soon.